On the 31st of October, 2011, a brokerage with a 200-year lineage filed for bankruptcy. Its bonds had not defaulted. Its central trade was narrowly correct, and roughly $1.6 billion of its customers' money had gone missing. MF Global was a futures and commodities broker with more than 3,200 employees. Its collapse ranked among the largest corporate bankruptcies in United States history. At its head sat Jon Corzine, former chief executive of Goldman Sachs, former United States senator, former governor of New Jersey. Corzine arrived in 2010 to transform a sleepy commission business into a Wall Street trading house. To do it, he put the firm's own balance sheet to work. The bet he chose would look, on paper, almost riskless. The way he financed it would prove fatal. The position was a laddered portfolio of short-dated European government bonds: Italy, Spain, Belgium, Portugal, and Ireland. Net long, roughly $6.3 billion as of the 30th of September 2011. Every bond matured no later than December of 2012. The logic was a carry trade. Buy stressed peripheral debt yielding high, finance it cheaply, and pocket the spread. Because the bonds matured before 2013, Corzine was betting the European rescue funds would carry these specific bonds to par. On the direction, he was right. None of them defaulted. But $6.3 billion was the net figure, roughly 5 times the firm's entire equity capital of about $1.3 billion. Reported leverage ran somewhere between 30 and 40 to 1. A move of 20% against the book could erase the firm's capital entirely. Here is the sleight of hand. Corzine funded the trade through repo-to-maturity. In an ordinary repo, you pledge a bond for cash and buy it back later. It stays on your books as borrowing. In repo-to-maturity, the repurchase date is set to the day the bond itself matures. Under the accounting rules then in force, because MF Global would never take the bond back, it matured inside the repo, the firm was treated as having sold it. Not borrowed against. Sold. The bonds came off the balance sheet, and the borrowing that funded them vanished with them. 2 consequences followed. The leverage financing the trade became invisible in the headline ratio, and the firm booked the profit immediately. At inception, the spread recognized up front. By early October, these trades had generated roughly $124 million in reported gains. But derecognition removed the asset from the balance sheet. It did not remove the obligation from the trading desk. MF Global still had to post collateral against those repos and keep posting it every day all the way to maturity. The bond left the books. The margin call did not. This is the core mechanism. As European spreads blew out through the autumn, the market value of the pledged collateral fell. The clearinghouse demanded variation margin to cover the decline, cash, daily. By late October, mark-to-market losses on the book approached $700 million. Then the loop turned reflexive. As MF Global's own credit rating fell, its counterparties demanded deeper haircuts and more collateral precisely when it could least afford them. The margin requirement rose because the firm looked weaker, which made it weaker still. Solvency was never the binding constraint. Liquidity was. The unwind was fast. On the 24th of October, Moody's cut the firm to 1 notch above junk. On the 25th, MF Global reported a quarterly loss of $191.6 million and disclosed the European position. Within days, the ratings agencies cut it to junk. Junk status was the trigger. Counterparties raised margin. Clearers raised performance bonds. Customers pulled their money. 3 cash drains hit at once: a customer run, a repo unwind and margin calls on the prop book inside roughly 72 hours. The firm ran out of its own cash. That is when the firm reached for the one pool it was never permitted to touch. Under regulator rules, a futures broker must keep customer funds segregated, held separately, never used for the firm's own needs. It is a legal duty, enforced by daily reconciliation, not a physical vault. The wall was eroded, not stormed. Investigators later pinpointed the 26th of October as the first unambiguous breach. On the 28th, roughly $700 million moved from customer accounts to the broker-dealer, and $175 million of customer money was loaned to the firm's United Kingdom unit. Over the final weekend, Interactive Brokers emerged as a rescue buyer for the futures business. The deal collapsed when the buyer's due diligence found the hole in customer accounts. On the 31st of October 2011, MF Global Holdings filed for bankruptcy. The broker-dealer went into liquidation. Customer accounts froze. The trustees' peak estimate of the shortfall reached roughly $1.6 billion, about $900 million from domestic customer accounts, and about $700 million from the pool serving customers who traded on foreign exchanges. In that foreign pool, the trustee found virtually no money had actually been segregated. On the 8th of December, Corzine told Congress, quote, "I do not know where the money is," end quote. The transfers had been executed by the firm's assistant treasurer, Edith O'Brien, under intense pressure to fix overdrafts. She denied wrongdoing. What investigators established was a failure of control, not a proven order to loot. And the money had not vanished. It was traceable. There were no investment losses inside the customer pool. The funds had been wired out to banks and counterparties in the final scramble for cash. The segregated account had been used, in effect, as an emergency overdraft the firm could not repay. Because it was traceable, it was recoverable. Through settlements and clawbacks, the trustee eventually returned roughly 100% of principal to some 26,000 commodity customers, with final distributions running into 2014. The lasting harm was the freeze, funds locked for months, hedges disrupted, not permanent loss. Corzine was never criminally charged. The case that stuck was civil. In January 2017, he paid a $5 million penalty and accepted a permanent ban from the futures industry for unlawful use of customer funds and failure to supervise. Not theft, not fraud with criminal intent. The episode rewrote the rules. Accounting standard setters killed sale treatment for repo-to-maturity. Those trades must now be booked as secured borrowings on the balance sheet, where the leverage shows. Regulators tightened customer segregation requirements. The specific escape hatch Corzine used was welded shut. The lesson is precise. Corzine won the solvency argument and lost the liquidity one. Repo-to-maturity let him book tomorrow's profit today and hide the leverage, but the one risk it could not offload, the margin call, is exactly what a thin broker cannot survive in a panic. The bonds were solvent. The plumbing was not. This is a post-mortem, not advice.